Just like the case of opportunity costs, you know, you record it as a cash outflow uh, in the beginning, but at the end of the project, you're going to return that to the firm. That means that's a cash inflow. There's a similar cash inflow at the end of the life of the project that's called salvage value of uh, capital assets. In the case of net working capital, we're talking about liquid assets. So whatever their value now, that's going to be the same at the end of the project. So we're just returning it back to the firm. But in terms of capital assets, their value right now is going to be very different from their value 10 years from now. You know, these computers, I think they're about 3 years old, if I'm not mistaken. 3 years ago, we probably paid them about $1,000 a piece, even assuming that we got them in bulk. Right now, if you want to sell these, I don't think you can get more than $200, if that, because you know they're old computers. They probably have only 4 processors. Even my 1 year old PC here, which also happens to be a Dell, better than HP's, has 32 processors, more memory, yada yada yada. And I paid only 1,200 for this last year. And it also has, you know, touch screen. You can write on the screen. But 2 years from now, I don't think I can sell this for more than 300, right? But there is a value to it. That value is called the salvage value. This is going to be relevant, and we will calculate the after-tax salvage value. And there's a reason you want to think about after-tax. Let's give an example. Let's say I bought this computer 3 years ago, and I can sell them right now for 200 bucks. And if I'm not mistaken, computers can be written off all the way to zero in 3 years, as far as the IRS is concerned. Now, let's make it simple so that I can divide evenly. Let's say I paid 900 for it. So over 3 years, every year I have written off $300 in depreciation. That decreased my taxable income by 300. And let's say my tax rate is 20%. That means over 3 years, that reduced my taxes by $60 a year. Over 3 years, $180 a year. Now, when you sell this thing for 200, IRS immediately says, "Objection, Your Honor." Why? Because in your books, this thing is worth only zero, because you have written the whole thing off as depreciation, but you sold it at 200, which means you made money. Well, if you made money, IRS is like a mafia boss. They're gonna want their cut, right? Or as the Italians would say, let me get my beak wet a little bit. That's the expression in Sicilian mafia, which means give me my cut. So they want their 20% of the 200, 40 bucks back. Okay. So after tax salvage is equal to pre-tax salvage, you know, the amount that you think you can sell it at, minus salvage taxes. And salvage taxes are pre-tax salvage minus book value at salvage time. times tax rate. In fact, we're going to build a template to calculate depreciation and salvage values, after tax salvage values under different depreciation methods, but those are relevant. One thing we haven't talked about is financing costs. And in fact, I'm going to claim that they are not relevant, and I'll make an argument to that effect. This is due to standalone principle. I mean, we're going to act as if the firm doesn't exist. Project is by itself. Well, if the project by itself, it's going to be equity financed, and in any case, we shouldn't care uh, whether or not a project is acceptable for us. Should not depend upon how it is financed. Firm makes that decision separately. Firm decides what sort of debt they want in their balance sheet. For example, right now, NVIDIA has close to $100 billion in cash, right? In cash and cash-like stuff. And more than likely, a lot of NVIDIA shareholders are pressuring NVIDIA board is, why don't you return that cash to shareholders as a special dividend? Why? Because cash earns the least amount of return. And what is it these days? 4%, 4.5%. Give me the option as the shareholder to put that money back into the shares of the company, because I expect the company overall to make more money. If NVIDIA does that, they're going to have to borrow money to finance their new chips and stuff. But that's a separate decision. That's called a capital structure decision, which we're going to kind of look at it at the end of the semester if we have time left. Because with this new 15, 14 week stuff and new textbook, I don't know what we can finish yet, because this is the first time I'm using this textbook. But either way, that should not be relevant. I'm kind of a little bit uh, not lying, but stretching the truth, let's say. The especially cost of debt financing still goes into the decision process, because as we're going to see later on, when we make calculations for cost of capital, that depends upon how much debt you use and what is the cost of debt and cost of equity capital. But that's a separate thing. In terms of cash flow, we're going to ignore. So if the firm uses $10 billion to finance the project and borrows it, and it pays $1 billion in interest, that doesn't mean anything to us. But cost of capital is going to be affected by that. But since we're going to use that anyway, but in terms of projection of the cash flows, any debt financing or financing costs is not going to enter into our calculations. Obviously, I shouldn't tell you that things like sales, cost of goods sold, that are obviously relevant. Okay, let me see. Oh, I have a good time. Today, I'm gonna build a template, Excel template for you guys to make depreciation calculations under different depreciation methods and regimes. And given those, we're going to make calculations on after-tax salvage values. First, depreciation methods. There are three main types of depreciation methods. Uh, your book also talks about the bonus depreciation thing. I'm not going to worry about that because I'm not sure it survived this new tax bill. One of them is called straight line, as the name suggests. Depreciate the assets in question to zero equally over the tax life of the assets. Not all assets have the same tax life. For example, let's say you bought a 3-year-old thoroughbred that actually has a tax life of 3 years. If you bought a yearling, more than likely that has 5-year tax life in terms of depreciation. You bought a truck, I think trucks are 5 years. Machinery could be 7, 10, 15, depends upon what it is. And physical real estate, not land, buildings, I think it's 20 years or something like that. In any case, this is not an accounting class. We're not going to worry about those. But IRS actually tells you for each asset what's the tax life. So if the asset had not depreciate. Apparently there is a word like that. What the hell depreciate means?